Today, we're diving into a topic that has revolutionized investing for millions of Canadians: exchange-traded funds, or ETFs. And to help us unpack it all, we have our esteemed guest, financial professional Jonathan Cartier, back in the studio. Hey, Jonathan, great to have you on the show once again. How's everything going in the market?
Between tariffs, the gold rush, and the general economic chaos in the market, I am living the dream, Rita. It's great to be back.
I can only imagine. Well, speaking of navigating the chaos, let's talk about the importance of exchange-traded funds in this ecosystem. For someone just starting, the term itself can sound intimidating. Can you break it down for us?
Absolutely. And it's simpler than it sounds. Imagine you want to buy a variety of fruits. Instead of going to the store and picking an apple, a banana, an orange, and so on individually, you buy a pre-packaged fruit basket. An ETF is that fruit basket. It's a single investment that holds a collection of assets, like stocks, bonds, or commodities, but it trades on a stock exchange just like a single stock, such as Bell Canada or Royal Bank.
That's a great analogy. So you get diversification in one single purchase. How does that basket actually get created and traded?
That's where the magic happens, through a process called in-kind exchange. An ETF provider works with a designated broker. This broker goes out and buys all the individual stocks that the ETF is designed to track, say, the 60 largest companies on the Toronto Stock Exchange. They deliver this basket of stocks to the ETF provider. In return, the provider gives the broker a large block of ETF units. The broker then sells these individual units to investors like you and me on the stock exchange. This whole process is incredibly efficient and is a key reason why ETFs have much lower costs compared to traditional mutual funds.
So the costs are lower because the ETF company isn't constantly buying and selling stocks with cash. The broker does the heavy lifting.
Precisely. And that efficiency has another benefit. It keeps the ETF's price very close to the actual value of the stocks it holds. If the ETF price on the exchange drifts too high or too low, the designated broker can make a profit by either creating more units or redeeming them, which pushes the price back in line. This minimizes what we call tracking error, the difference between the ETF's performance and the index it's meant to follow.
That makes sense. Now, I know there isn't just one type of ETF fruit basket. Can you walk us through the different flavors available to Canadian investors?
Of course. The most common is the standard or index-based ETF. This is the classic fruit basket we talked about. It aims to replicate a well-known market index. A perfect Canadian example is the iShares S&P TSX 60 Index ETF, which is one of the oldest and most traded ETFs in Canada. It simply holds the 60 largest publicly traded companies in the country. Then you have rules-based ETFs, often called smart beta. These are a bit more selective. Instead of just buying the biggest companies, their rules might focus on companies with high dividend yields, stable earnings, or low volatility. Think of it as a basket of only the sweetest, highest quality fruits.
So it's a passive index, but with a specific strategy built in.
Exactly. Next are active ETFs. Here, a portfolio manager is actively picking the stocks, much like a traditional mutual fund, but with the trading flexibility and lower cost structure of an ETF. A Canadian example is the Horizons Active Emerging Markets Dividend ETF. These tend to have slightly higher fees than passive ETFs because you're paying for that active management. We also have more complex types, which are generally for more experienced investors. Synthetic ETFs use derivatives like swaps to get the return of an index without actually owning the underlying stocks. Then there are leveraged and inverse ETFs. Leveraged ETFs aim to deliver, say, 2 times the daily return of an index, while inverse ETFs aim to do the opposite. They go up when the index goes down. A fund like the Horizons Beta Pro S&P TSX 60 Inverse ETF is a good example. But a word of caution, these are designed for very short-term trading, often just for a single day, and are not suitable for long-term investors.
That is a crucial warning. What about tangible things like gold or oil?
That brings us to commodity ETFs. These give you exposure to commodities. They can be physical-based, where the fund actually buys and stores gold bars in a vault, for instance, or they can be futures-based, where they invest in contracts for future delivery of the commodity. And finally, a popular category in Canada are covered call ETFs, like the BMO Covered Call Canadian Banks ETF. These funds hold a portfolio of stocks, in this case Canadian banks, and they sell call options on those stocks to generate extra income for investors. It's a strategy to enhance yield, but it can cap your upside potential if the stocks rise sharply.
Wow, Jonathan, this sheer variety is incredible. It's clear that ETFs have opened up strategies that were once only available to large institutional investors. This is such a valuable breakdown. And for our audience, if you're finding this information valuable, please take a moment to hit that subscribe button and share this episode. It helps us keep bringing experts like Jonathan to the table. Remember, you can listen on Spotify, Apple Podcasts, YouTube, Podbean, Audible, and many more. So, Jonathan, with all these options, let's talk about the practical application. How important are ETFs in building a personal investment portfolio for the average Canadian?
They are fundamentally important. ETFs are perfect for building the foundation of a portfolio. This is what we call a core and satellite strategy. Your core could be one or two broad market ETFs, like one that tracks the entire Canadian market and another that tracks the US or global markets. This gives you massive, low-cost diversification instantly. These core holdings are designed to provide the majority of your long-term steady returns. Then you can add smaller, more targeted satellite holdings. Maybe you believe the clean energy sector has high growth potential, or you want more income from covered call strategies. You can use sector-specific or thematic ETFs for these satellite positions to try and boost returns above your core holdings. This approach gives you the best of both worlds, a stable, diversified foundation with the flexibility to make targeted bets.
That sounds like a very logical and accessible approach. A lot of our listeners probably have mutual funds. How would you compare ETFs directly against them?
It's a great question, and there are key differences. Management style. As we've discussed, most ETFs are passively managed, aiming to match a market index. Most mutual funds are actively managed, trying to beat the market. Cost. This is a big one. Because they are typically passive, ETFs generally have significantly lower management expense ratios than active mutual funds. Trading. ETFs trade like stocks throughout the day. You can buy or sell them at any time the market is open, and their price will fluctuate. Mutual funds are priced only once per day after the market closes. Transparency. Most ETFs disclose their full list of holdings every single day. With mutual funds, you often only get to see the top 10 holdings once a month. Tax efficiency. ETFs tend to be more tax efficient in non-registered accounts. The in-kind creation process helps them avoid triggering as many capital gains as mutual funds, which have to sell securities to meet investor redemptions.
It seems the advantages of ETFs are quite compelling, especially on the cost and transparency front. But what about the risks? Are there any dangers specific to ETFs that investors should be aware of?
Absolutely. No investment is without risk. One key risk is tracking error. This is when the ETF fails to perfectly match the performance of its index. It can be caused by the fund's fees, the method used to replicate the index, or cash drag. Another is concentration risk. Just because an ETF holds 60 stocks, it doesn't mean you're perfectly diversified. In Canada, many broad market ETFs are heavily weighted towards the financial and energy sectors, so a downturn in banking could still have an outsized impact on your diversified ETF. Finally, there's a risk related to securities lending. Many ETFs lend out the stocks they hold to short sellers in exchange for a fee, which can help offset costs. While this is generally safe and collateralized, it does introduce a small amount of counterparty risk, the risk that the borrower might default.
That's a very balanced perspective. It's not just about the benefits, but understanding the full picture. Jonathan, this has been an incredibly insightful masterclass on ETFs. Before we wrap up, what is one final piece of advice for a listener who is now ready to buy their first ETF?
Start simple. Don't get overwhelmed by the thousands of options out there.
Begin with a broad, low-cost index ETF that tracks a major market, like the S&P TSX 60 in Canada or the S&P 500 in the US. Use it to build your core. And most importantly, do your homework. Every ETF has a public document called ETF Facts, which is easy to read and tells you everything you need to know about its objective, fees, and risks. Read it before you invest.
Start simple and read the label. Fantastic advice. Jonathan Cartier, thank you so much for breaking down the complex world of ETFs for us today.
My pleasure, Rita. Always happy to be here.
And a huge thank you to our audience for tuning in. Don't forget to like, share, and subscribe to Money Talks. Join us next time as we continue to guide you through the world of Canadian securities.